Good morning, colleagues and members of the GEPF. My name is Sonke Dandala from the Stakeholder Management and Communications Department. I'd like to begin by welcoming you all to the second webinar on the two-pot or two-component system as it's stated in the legislation. If I can just begin by just asking if you look at the screen, there is a section that is titled Q&A. If I can just first get an indication that I am audible and that you can see my screen, perhaps someone can just type a message in the chat, in the Q&A chat for me, just to indicate that I am audible and that the screen is visible. The session is being run on a Teams platform called Town Hall. The reason for us using Town Hall is because it allows up to 10,000 people to join a session at a time. Join up to a session at a time. So what then Team Hall does do is that it then means that it operates on the basis that you are not able to speak back as you would do in a normal Teams meeting, but you do have access to the Q&A chat to pose your questions during the presentation or towards the end of the presentation at any point. I've received confirmation in the chat from Jonathan Goliath that I am audible. Secondly, if someone can just confirm if the presentation, if the screen is up and visible. Yes, I've now received confirmation from Darren Maseka, confirming that I am audible and that the screen is visible. Without any further ado, then, I think let's get into it. We do have quite a bit to cover, and I'm hoping that most of you colleagues have a good idea at this point about the system. We will go into a little bit more detail in kind of a little bit more practical elements that I hope will assist you to clear up maybe areas where you are still unclear or a bit unsure. But I would hope that at this point that many colleagues are quite comfortable with the general idea of the two-component system in terms of at least understanding it and knowing what it is about. But then that this webinar can then assist you to just give you extra bits of clarity in terms of how it will be rolled out and how it will be implemented. Then I'd just like to say, colleagues, please continue to post your questions in the chat. The chat is being reviewed, so you will not be able to see your questions immediately. What I will do is that at the end of the presentation, I will go through the questions one by one and publish them and then respond to them accordingly. So if you do not see your question in the chat, do not be concerned. It's in the review. There's a review section where the questions are reviewed, and then we will then publish at the end of the session and kind of take some time to review all the questions that have been posed by different people in the chat. Okay, I think then let's get into it. As I said, it is going to take a bit of time to go through the presentation. It is quite a bit of content to cover. I will try go through it as thoroughly as possible. I will skip over some sections and not spend too much time and really focus on the areas that I believe might help you to get further clarity on the process. So, welcome, colleagues, to the presentation on the two-component system. That is actually how it is worded in the legislation. However, it is obviously colloquially called the two-pot system. Just an overview of the agenda that we'll go through. We will go through just a very brief background. I won't spend too much time there. Then we can begin to go into the detail of the system, what it means, going to the various pots. We'll spend some time talking about the changes and the implication on benefits. We'll then touch on the claims process as well, which is in the process of being finalized. Then there's a slide just to give you some advice, members, in terms of how we believe as the GEPF you should treat the system. And then, as I mentioned, at the end, we'll go through the chat to respond to all the questions that have been posed by colleagues. So where did it all start? Just a very brief background. I'm sure you have heard this. COVID was obviously an extremely difficult time for many South Africans, particularly in the private sector where there was a slowdown in the economy, leading to people either losing their jobs or their salaries being cut, which then obviously led to a lot of people struggling in terms of them being able to meet their obligations, whether it's their bonds, school fees, and other loans that they have to pay off. However, even despite the situation, people were unable to access their pension benefits to assist them during this difficult time. So because of these pressures, it became important for the government to consider a way to provide two elements. That is, to allow members to have access to their pensions during times of emergency or difficulty, whilst at the same time also encouraging South Africans to save more. So the rationale for the amendment is therefore on two fronts. We have a situation in South Africa where only 6% of people retire comfortably. By retiring comfortably, we mean that from the day that a person was working into the day that they begin retirement, there is no change in their living circumstances. But for most people, there has to be a change. People have to downgrade their houses, they have to downgrade their cars because they simply have not saved enough for retirement. So the first element of the legislation is to help South Africans to preserve more of their money for retirement. The second reason is then the one I alluded to in my earlier point, which was to allow some flexibility for people to access a portion of their funds during times of difficulty. And this is the main reason for these reforms. Then also a key point to mention at this point, colleagues, is that this reform applies to all pension funds. It applies to the private sector, it applies to the public sector. So no one is exempt or immune. Any person that works, whether they work in the private sector or the public sector, and they have a pension fund, this new system applies to them. So it is not a GEPF program. It is not a public sector program. It is a South African program that is reforming the entire pension system for all South Africans, regardless of which sphere they work in. Okay. So going into the details, so the system will begin formally on the 1st of September. And the reason it's called a two-pot system is that from the 1st of September, members' pension benefits will accrue into two components or to two pots. One pot is referred to as the savings pot, and the other pot is the retirement pot. This is the basis for calling it the two-pot system. However, as colleagues sit here in this webinar this morning, all of us have pension funds that we have accrued and that we will have accrued up until the 31st of October 2024. The 31st of August 2024. So all those retirement benefits will be placed into a pot that is called the vested pot. Now, what you've got to consider about the vested pot is that you've got to consider the vested pot. It's your pension that you've accrued until the 31st of August 2024. And what that means is that the current pension rules apply to the vested pot. So this is the reason why the system is called two-pot and not three-pot, because the vested pot, it is the current rules or the previous laws that will apply to the vested pot going forward into the future. So it is not in the new system. The new system is the two-pot system with the savings pot and the retirement pot. What will be allowed on the 1st of September, in fact, let's not call it allowed, what will happen, because colleagues do not have an option to opt out, colleagues will be allowed to seed a portion of the vested pot into the savings pot. The value of the amount that will be seeded into the savings pot from the vested pot is 10% of the member's vested retirement savings as at the 31st of August 2024 to a maximum of 30,000 Rand. And this is what we refer to as the seed capital. This process, colleagues, is not optional. Colleagues are not going to be asked or given a process or given an option to say, would you like to seed your funds from your vested pot into the savings pot? This is going to be an automatic process that is going to be generated in the back end, that colleagues 10% or a maximum of 30,000 Rand of their pension will be placed into the savings pot. You will not be required to complete any form to provide any indication whether you want to do this. Nobody has a choice. This money will simply be moved from your vested pot into your savings pot. Okay, so this is what this covers. So to reiterate, the move from the vested pot of the 10% into the savings pot is automatic. Members are not required to do anything around it. And then importantly, colleagues, the split of the different pots of the savings pot and the retirement pot, it's what we call, it's done on a notional basis. We won't physically be separating your savings pot and your retirement pot in terms of how the pots are invested. So we won't take your savings pot and which is separate and invested separately, and then your retirement pot invested separately. The investing will continue as it has done in terms of a combined pot in the fund. The separation is simply on a notional basis for us to be able to keep track of what's in your savings pot and your retirement pot. Let's dig a bit deeper. Okay. So the vested pot, this is a bit of what's created a bit of confusion with some people. It's the third wheel, but as I've explained, the old rules apply to the vested pot. Hence, the new system is called the two-pot, because what is new and applies to the new system is the savings pot and the retirement pot. Okay. Again, on the 31st of August, everybody's current savings, the entire amount of the member's pensionable service that they have earned. It doesn't matter whether a colleague has been working for 1 year or a colleague has been working for 30 years. That entire amount that has been accumulated up until the 1st of August will be placed into the vested pot. Okay. Benefits in the vested pot, again to reiterate, will operate under the current regime in terms of accessibility. So just to summarize on that, the old rules, to make it simple, apply to the vested pot. Without getting into too much detail, for example, if you resign at any point in the future, whether you resign at the end of September or you resign on the 1st of January 2025, you will be able to access your entire vested pot. So that's to just illustrate the point that the old rules apply to the vested pot. It's the current regime that will apply to the vested pot now and going into the future post the 1st of August. Importantly, your vested pot is not stagnant. If you remember, colleagues, the way that we work out GEPF benefits, they are worked out based on pensionable service multiplied by average salary, multiplied by the actuarial factors, which take into account the ages of members, economic factors, etc. So what will be locked in your vested pot as of the 31st of August is only the factor of service. So if at the end of on the 31st of August 2024, a colleague has 10 years of service, the value of their vested pot will forever be calculated on 10 years service. I hope that is clear for colleagues. Okay. So let's actually make it practical and take an example. Let's say a member is 40 years old. They have 10 years of vested service as at the 31st of August or the 1st of September, and they have a final salary of 300,000 rand. If we calculate the value of their benefit, as I mentioned, what we do is we take the pensionable service of 10 years, multiply that by the member's salary of 300,000 rands, multiplied by the actuarial factor. In this case, for a 40-year-old male, the actuarial factor is 0.20360, and that then works out to a balance of 610,800 rands. So this is what the member will have as their pension on the 31st of August. Okay. Now, to illustrate the point of the vested pot not being stagnant, but the fact that it does change. Suppose that now we are a year later. It is now the 31st of August 2024. And the member's salary has increased to 315,000. What that then means now is that when we calculate the member's benefits, we now use 10 years again, because now the vested pot is locked at 10 years, because no more benefit is accruing, no more pension benefits are accruing into the vested pot. So the member's pension benefit a year later would then be 10 years multiplied by the member's new salary, 315,000 rands, multiplied by an updated actuarial factor because the member is a year older of 0.20431%, and that means that the member's vested pot a year after the implementation of the two-pot system will be 643,000 rands, 576 rands. Colleagues, this is simply to illustrate the fact that the vested pot is not stagnant. If your pot at the end of August, at the end of this month, when we begin the new two-pot system, for example, is 300,000 rands, it does not mean that when you retire, when you reach the age of 60, your vested pot will also be 300,000 rand. Your vested pot will increase with your change in salary and your change in the actuarial factors. So it does not remain stagnant. It does change and it will change. Okay, then let's move on to the issue of the seeding capital. Again, to reiterate, this process is non-voluntary. We will take 10% of the value of your pension up to a maximum of 30,000 rand, and this will be seeded into your savings pot. So, for every member that is on the call now and is an active employee, on the 1st of September, your existing pension will be put into a vested pot with whatever value of amount that you've accumulated. Let us use the example that we just passed. Let's say there's 600,000 rands in the vested pot. We will open a new savings pot with a zero balance. We will then also open a retirement pot with zero balance. Thereafter, we will seed 10% to the maximum of 30,000 rand of what is in your vested pot into your savings pot. This will be applied automatically across all members. Again, let us look at a practical example. At the end of August or 1st of September, a member has 500,000 rands available in their vested pot. The seed capital amount for this member will be, if you take 10% of the members, the value, 10% of the member's pension, that equates to 50,000 rand. We will not seed 50,000 rand for the member. We will seed the maximum that is allowed, which is 30,000 rands, into the savings pot. So if you look at the table before, you can see the slide before the seeding. The member has 500,000 in the vested pot, zero in the savings pot, zero in the retirement pot. After the seeding, the member has 470,000 in the vested pot, 30,000 rands in the savings pot, and 0 rands in the retirement pot. This will happen automatically for all members, and there are no implications in terms of cost or tax or anything. At this point, then, the vested pot is locked and no more transfers will ever be allowed again from the vested pot into the savings pot. Let us use the example again of a member who has their current pension value is 100,000 rands. 10% of 100,000 rand is 10,000 rands, which that means that is all that is available for the member to be seeded into their savings pot. So in this example, before the seeding, the member has 100,000 in the vested pot, zero in the savings pot, zero in the retirement pot. After the seeding, the member has 90,000 in the vested pot, 10,000 rands in the savings pot, and 0 rands in the retirement pot. Okay, so that is to explain the seeding and how it will happen. Key point, 10% of the value of your pension to a maximum of 30,000 rands. Seeding is automatic. None of us can opt out. It will be done for us. No action is required from our part. There are no cost implications for it. There are no tax implications for it. It is simply a transfer that it will happen automatically. Yeah. So the savings pot is the new guy in town, and this is the pot that members can potentially be excited about. Yeah. So we have made the point that the transfer from the savings from the vested pot into the savings pot is automatic. Thereafter, this once-off transfer from the vested pot to the savings pot is not taxable. There is no cost whatsoever. It's simply an intra-pot transfer. Then thereafter, the first new important point, thereafter, your pension will now accumulate. 1/3 of it at a month will now begin to accumulate in your savings pot. Okay. So if you consider your first contribution that comes in at the end of September, 1/3 of it, or your pension accumulation, will accumulate in the savings pot. 1/3, 2/3 will accumulate in the retirement pot. We'll go into more detail on the retirement pot a bit later. Okay. What does this savings pot then allow? So this is the major change in the pension legislation, colleagues. Under current rules, under current rules, we are not allowed to access any of our pension, whether we work in the private sector or we work in the public sector. We cannot make a withdrawal from our pension whilst we are still in employment. The only way for us to access our pension currently is if we resign from our jobs or we go on retirement. In between, there is no opportunity while still in employment to withdraw any of our pension savings. The savings pot is this major change. Going forward, we will be allowed to make withdrawals from our savings pot whilst we are still in employment. Okay, we do not have to leave employment to access these funds, and it is suggested that we should use the savings pot as a means to access funds in times of emergency. The amount that is available for withdrawal is the maximum of what a member has in their savings pot. They do not have to withdraw the maximum, but the maximum is available of whatever the amount is in the savings pot. To clarify a myth, it is not that we can only access 30,000 Rand a year. That is incorrect. It is whatever the maximum is in the savings pot. Okay. Members will be able to make a withdrawal from this pot once in a tax year. The tax year runs from the 1st of March to the end of February each year. Amount that the member chooses to withdraw from their savings pot is taxable. Whatever amount that the member withdraws is taxable, colleagues. It will be taxed according to your marginal tax rate. What your marginal tax rate is simply means it will be taxed similarly to your salary. SARS will look at your salary scale in terms of what you earn, what tax bracket you are in, and that is what will then be used to charge the tax on the withdrawal that you make. Okay, just to assist you, colleagues, and to start with a disclaimer, the GEPF is not responsible for the tax rates. The tax rates come from the South African Revenue Service. They are responsible for determining the tax laws, and the GEPF, like any other fund, is compelled to apply them in terms of the law. Okay. If a colleague wants any clarity in terms of what tax bracket they're in, etc., you can have a look at the SARS website. We've put the tax rates there in for you. As an example, if you need any clarification with regards to tax, we do recommend that colleagues speak to SARS for deeper information. What we're giving you here in terms of the tax is just the basic information. So your withdrawal that you make from the savings pot will be taxed according to where you sit in these income brackets. So a person that sits in an income bracket of between 370 to 512,000 is taxed at a rate of 31%, and you can see some of the detail there in the amount within the bracket. So if you make a withdrawal from the savings pot, it will be taxed at that rate. Okay. The withdrawal tax rates, these ones refer to exits. So this is now not the tax rate for when you withdraw from your savings component, but this would then apply when you withdraw upon resignation and you withdraw your pension benefit. These are the withdrawal tax rates, and they are slightly different, and they refer to the amounts that you withdraw. So this would be when, to clarify, colleagues, the previous slide is when you withdraw from the savings pot, charged at your marginal tax rate. This table refers to when you leave the fund, when you choose to withdraw. So, for example, upon a resignation, and then these are the rates that would apply. So that's just to help create differentiation there for colleagues. But for the withdrawal from the savings pot, it is according to your marginal tax rate. Okay. Let us again delve deeper into the savings pot. Let us show you, this is a practical example to show you how the savings pot will accumulate. Okay, so let us look from where we are looking from left to right. The first column is the 1st of September 2024. The very last column is the 28th of February in 2025. So roughly eight months from now. Okay. So before the seeding, as we've explained, I won't go into detail. In the example, the member has a final salary of 300,000. He's 40 years old. There's zero balance in the savings pot. That is his actuarial factor, and his savings pot has a balance of zero. The second column shows what happens after the seeding of the 30,000 Rand. So final salary remains the same, age remains the same, but now, as an example, what we will keep track of, the member now has a savings service, which is 1/3 of their pension contributions. In this example, we've taken the random number of 0.49% of 0.49. So the member has a savings service of 0.49. The actuarial factor hasn't changed, and they have 30,000 Rand in their savings pot. If you then progress to the end of September 2024, salary remains the same, but the member is now 1 month older. He's 40 years and 1 month older, which means, and in the fund as well, his savings service now has increased by a month to 0.52. The actuarial factor has changed slightly because his age has changed, and he has now accumulated in his savings pot 31,705 rands. A month later, at the end of August, the member is now 2 months older. The pensionable service has now increased again to 0.55. The actuarial factor has changed. The savings balance now is 33,000 rands. A month after that, the member is 3 months older, 40 years and 3 months older. The the savings service has now increased to 0.57. The actuarial factor has changed again because the member is older. He has now accumulated 35,000 Rand. And so on it goes, colleagues, until in this example, we are at the end of February 2025, and the member has accumulated now in his savings pot 40,921 Rands. Okay. I hope, colleagues, that this is clear. This is to indicate that with each month that passes by, a member will accumulate more service period in the savings pot, which then means that the balance of the pot will also increase. So when the new tax year opens on the 1st of March 2025, this specific colleagues could choose to withdraw what the entire amount in their savings pot, which is the 40,921 rands. So this is to illustrate, colleagues, that the withdrawal is not capped at 30,000 rands per annum. A member can choose to withdraw whatever amount they have accumulated in their savings pot. In our example, the member could choose to withdraw 40,000 Rand and 900 Rands at the time of the new tax year in March 2025. Okay. Colleagues, one key point here that I'm sure you have heard, the withdrawals from your pot, from your savings pot, are not a free lunch. Okay. Two things to clarify about the savings pot. It is not a loan. There is no expectation for you to repay the funds that you have withdrawn from the savings pot. It is not a loan. However, what it does mean is that you are taking funds out from your future pension benefits, and we have to account for this. The way that we will account for this is in terms of pensionable service. Okay. So what we will do is that your final benefits that will be accrued to you when you go on retirement, the withdrawals will be accounted for in terms of pensionable service, and we will reduce your pensionable service in that way and your benefits accordingly. Okay. Here is an example in terms of how the pensionable service will do. It's the past example. I think what I would want you to pay attention to is row number 3, which is the saving service before withdrawal. And you will see there up until the end of November, the member has not made any withdrawals, and his saving service has accumulated from 0 to 0.59, 0.52, 0.55, 0.7. On the 12th month, at the end, on the 31st of December 2024, the colleague decides to make a withdrawal of 36,829 rands, which means he withdraws the entire amount in their savings pot. You will then see that at the balance at the end of December 2024, his balance then in the savings pot becomes 0, which means then that his service in the savings pot has been reduced, and you will see that from December to January it moves from 0.6 to back to 0.03 because he has made a withdrawal. And then again, he begins to accumulate funds in his savings pot. You will see at the end of January, he now has 1,700 rands only. And then at the end of Feb, he has 3,455 rands. What this illustrates, colleagues, the point of this slide is to show you that when you make a withdrawal, the saving service that you've accumulated in the savings pot will be reduced accordingly. Okay, in terms of what you have withdrawn. Okay. An important point, colleagues, just to close off, the value of the reduction in terms of service. It will be calculated for each member because it cannot be the same because we contribute different values to our pension. Okay, so there is nothing like if a person withdraws 30,000 rands, that is equivalent to a reduction of 1 year service. It is not correct. There is no standard because if one colleague contributes 10,000 rands towards their pension and another colleague only contributes 5,000 rands, if both of them withdraw 30,000 rands, it will have a different impact in terms of their service. So it will be calculated for the colleague that has a contribution of 10,000 rands per month, the reduction of service will be less. And for the colleague who pays 5,000 rands a month, the reduction will be higher because their pension contributions are different. So colleagues, that's another important point. There is no standard value. There's nothing like if you withdraw 30,000 rands, the GEPF will reduce your service by 1 year. It is not correct. It will be calculated according to your specific circumstances. Okay. On the service reduction example, at the point of retirement, the GEPF will take into account all those withdrawals, convert that into a service reduction, and accordingly reduce your benefits according to what you have withdrawn and what that calculation will be. Okay. Importantly, colleagues, again, with regards to SARS has confirmed that when members choose to withdraw from the savings pot, if a member has any arrears that they owe SARS reserves the right to deduct what the member owes to SARS before they pay out what they withdraw. A very important point, colleagues. So if you choose now that you are going to make a withdrawal of 30,000 rands, SARS will tax the 30,000 rand at your marginal rate. If SARS then finds that you owe them arrears in tax because you have not been filing your tax returns, they will further deduct that amount from the 30,000 benefits, and then they will pay you the balance of whatever is left. So it is important for colleagues to be cognizant and aware of this. It is completely legal. SARS can do it. They do not have to consult you or anything. They will simply deduct all the funds that are owed to them. Okay. So let's make an example. A member has 50,000 rands in the savings pot, and then they decide to withdraw 40,000 rand. The member falls, let's assume the member falls within the tax 26% income bracket. When the member sends the application for withdrawal, the GEPF will get a tax directive from SARS. SARS notes and indicates that the member also has unpaid taxes, as an example, of 10,000 rands. This will be the scenario. SARS will work out the 26% on the 40,000 rands, which works out to an amount of 10,400 rands. Then they must also take into account the 10,000 rands of outstanding tax that the member owes, which then means that the member in their bank account will receive 19,600 rands, because SARS will deduct from the 40,000 10,400 rands, which is the marginal tax, minus what the member owes of 10,000 rand, therefore leaving the member with 19,600 rands in their bank account. Please be cognizant of this, colleagues. Before you make a withdrawal, understand your position with SARS, where you sit, where you stand, do you have any arrears owing, so that you are clear and you understand what will eventually land into your bank account. And another important point, where an employer has obtained a judgment against a member, for example, for fraud, theft, dishonesty, or any kind of member misconduct. If a member takes a savings withdrawal benefit, there will not be sufficient value in the fund to pay the employer. If the fund is notified that the member is in the process of getting divorced, the non-member spouse must consent to the member claiming a savings withdrawal benefit. And also important one, colleagues, that affects a lot of members is with regards to a maintenance order. If they take a member who has a maintenance order against them, if they take a savings withdrawal benefit, there could not be sufficient value left in the fund to pay the maintenance. And therefore, where the fund receives notification whether the maintenance order is pending against a member, and there is an interdict prohibiting the fund from paying a savings withdrawal claim, and if they take a savings withdrawal benefit, there will be not sufficient value in the fund to pay the maintenance order if granted. So these are specific and unique circumstances, colleagues, that you must be cognizant of and understand how these will be implemented by the fund. That is the savings pot. I'm sure there are many questions. We'll go through the questions, as I said, at the end. We'll go through the chat and look at all the questions that the colleagues have. Let's go into the retirement pot. And what we're saying here, this is the vehicle that is now being used to take into account the issue of only 6% of people being able to retire comfortably today. This is now what we would call forced preservation. Whatever we accumulate in our retirement pot after the 1st of September, we will not be able to withdraw until we go on retirement. Okay. There will be no withdrawals allowed from the retirement pot, which will begin to accumulate a value of 2/3 of your pension from the 1st of September 2024. The only exception where with money will be taken from the retirement pot is in the case of divorce, where a spouse has received a divorce order that says the GPF must pay them. A portion of the members' funds will be withdrawn from the retirement pot and paid to the member in cash. Another exception is the retirement pot is normally used to set up a retirement income. However, if the value of what is in the pot at the point of retirement of a member is 165,000 rands or less, the member can make a withdrawal and take the entire amount in cash. Those are the exceptions with regard to the retirement pot. But the key point to understand, your retirement pot on 1 September has 0. It will then start to accumulate pension, which is equivalent to 2/3 of your pension going forward. That amount that accumulates from 1 September going forward, should you choose to resign in the future, you will not be able to access that pension. You will only be able to access it upon retirement. Another important note for any members who are considering emigration, in terms of the retirement pot, a member who emigrates will not be able to access their retirement pot for a period of 3 years after emigration. Current provisions related to payments of benefits to the beneficiaries of deceased members still apply. If a member passes on, the value of what is in the retirement pot is paid to the member's beneficiaries as per their nomination pot. What is in the retirement pot in that instance is taxed according to the retirement tax tables. So the retirement pot, colleagues, its main role is to ensure that people do not exhaust their pension benefits during their working life, but that it is guaranteed that at the point of retirement, there are funds available for them for retirement. Okay. These are the retirement tax rates. Again, this is just the basic to give you an understanding in terms of when you go on retirement. The tax rates, if you were to compare them, the tax rates for resignation are higher. People going on retirement are taxed less. Okay? These are the retirement tax tables that would apply at the point of retirement. But for a deeper understanding, if colleagues want to understand more, they're welcome to contact SARS in order to get further detail. Okay. So importantly, what is changing going forward? Okay. So important point, colleagues, currently now, each person's pension benefits is calculated according to one service period. So a person has worked for 30 years, their pension benefit will be calculated 30 years multiplied by average salary multiplied by the actuarial factor. This will change going forward. In your benefit statement, you will now see 3 service periods. You will see your vested service period, which is your pension benefits up to the 31st of August 2024. And again, to reiterate, that service period is locked. If you had at the end of the end of this month, you had 10 years service, your vested period will always be calculated on 10 years, multiplied by your current average salary times by your current actuarial factor. So what you will see in your benefit statement is your vested service. You will also see the value of your savings service. Okay. So what you have accumulated in your savings service from 1st of September going forward, and it will also show you when you have made withdrawals, how your service has been reduced accordingly. Okay, so you will see it in your benefit statement. It will not be a surprise when you retire, when you eventually get to retirement age. GPF will not spring a surprise on you and say, all these withdrawals that you have made this year amount to 5 years. You will see it each time you make a withdrawal. You will be able to see it in terms of your savings service period. It will show you that in year X you made a withdrawal and your service was reduced accordingly. So you will see this. It will not be a surprise at the point of retirement. Then the third service you will see, which is 2/3 of your pension that is accumulated, you will see in the retirement pot. Okay, so your total service now, instead of being one pot, which is one service period, will be your 3 pots together: your vested service, saving service, and your retirement service. And you will see this in the savings pot. There's no need for us colleagues to get into the example, but if you look at those last 3 bullet points, make an example. So this member's pension benefit is calculated by adding up the vested pot of 10 years service. At the end of September, he has 0 years service. So this is currently at the 1st of September 2024 when we begin the service. So the member has 10 years service, has 0 years service in the saving service, and 0 years in the retirement service. A year later, again, colleagues, if you just look at the bullet points in red, so at the end of, on the 1st of September 2025, in a year's time, the member still has 10 years service in their vested pot, because now that will never change. But there might be a new salary and a new actuarial factor. His saving service has now contributed 1/3, increased by 1/3 of his pension contributions, which is 0.33 years, and his retirement service has accumulated by 0.667 years, which is 8 months in terms of the retirement service and 4 months in terms of the saving service. This, colleagues, is the detail that you will see going forward in your new benefit statement. Okay. Then let's take an example again just to illustrate the point. Now assuming that the member makes a withdrawal from the savings pot on the 31st of August. Okay, so the member has 10 years pensionable service, which is and has been a GEPF member for 11 years. And the reason for that is because 10 years service in the vested period remains, but because the member has made a withdrawal from the savings pot, the savings service is reduced again to 0 years, but his retirement service has accumulated 0.6677 years of service. Okay. So an important point to illustrate here is that this shows that your pensionable service is not the same as your period of membership. Okay. So effectively, this member has worked for 11 years and been a member of the GPF for 11 years, but his pensionable service has been reduced because of the withdrawal that they have made from their savings pot. In this example, it has been reduced by 4 months because he has made a withdrawal. Okay, so colleagues must be clear and be able to make a distinction between the two, which is being your pensionable service versus being your period of membership. To this issue of purchase of service. Currently, GEPF members are allowed to purchase service in order to increase their service years. This often happens, as an example, when a member reaches retirement and you find, for example, that the member has 9 years service instead of 10, which would mean if a member has 9 years service, they would only be entitled to receive a lump sum and would not be able to get a monthly pension. A member, for example, will then use purchase of service to purchase a year's service, which gives them 10 years of service, which then means in terms of benefit, they would be entitled to receive a monthly pension as well. So this is a tactic that members use in terms of purchasing service. What will happen going forward in terms of purchase of service? Okay, the service that a member has purchased prior to the 1st of September is obviously allocated to the vested pot. But going forward, this purchase of service is still allowed in order to increase the members' benefits. But service that a member now purchases post the 1st of September will be allocated to the savings pot and the retirement pot. Okay, so it will be split between the two pots. It will not, for example, if a member decides to purchase 2 years of service, as an example, that 2 years of service will not be placed only in the savings pot or only in the retirement pot. It will be split 1/3 into the savings pot, 2/3 into the retirement pot. So you won't be able to just purchase service and only put it in the savings pot. It will be split amongst the two pots. Okay. I hope, colleagues, this is clear to you. This is an example of a benefit statement or an example of what the benefit statement will look like going forward. If you look at the top block, you will see there it will show you what your vested component service is. In this example, it's 14 years for this member and 7 months. This is at the 1st of September. The member has a savings component of 0 years and 0 years. And then it has a retirement component of 2 years and 5 months. And then the benefits will then be accumulated accordingly. And you'll see that the table at the middle there shows the values. Vested component has 1.3 million, savings pot has 27,000, and retirement pot has 255,000, leading to a total benefit of 1.6 million. So, colleagues, this is how you will now see, this is what you will now see in your benefit statement, and it will also indicate the normal information regarding your resignation if you choose to resign, your pension that will be paid to you, and what's in your retirement fund, etc. Yeah, colleagues, I think this explains the same point. Your pension benefit or your actuarial interest is now calculated according to your 3 pots, which are then added up accordingly. Yeah. Currently, in terms of current rules, if a member resigns, they are able to take their entire pension with them as at today. Going forward, what members will be able to take if they go on resignation post the 1st of September, to reiterate, members will be able to withdraw their vested pot and their savings pot. Okay. And their savings pot. Members will not be able to withdraw what has been accumulated in their retirement pot. They will only be accessed that can only be accessed their retirement pot upon retirement. A key point to make, colleagues, as well, if a member chooses to resign, as I said, they can take their vested pot and their savings pot as a cash benefit. The retirement pot, they cannot access. However, colleagues are allowed to transfer the retirement pot. You are not obligated to leave your retirement pot within the GEPF. You can do so if you choose, but let us say a colleague leaves the public sector and they get new employment in the private sector, therefore they resign their current post. They will receive their vested pot. They can receive their vested pot and their savings pot in cash if they choose. They can transfer it to the new employer as well. They can also transfer their retirement pot to the new employer. But their new employer as well will then take their retirement pot and put it into their new retirement at the new employer. It will not be paid to them as a cash benefit. So important colleagues, reiterating for the last time, if you resign, you are able to take all your 3 pots, receive the vested pot and savings pot as a cash lump sum if you choose. The retirement pot you transfer to your new employer if you choose, or if you choose, you can leave it within the GEPF. We hope that is clear, colleagues. Okay. So let us look at an example. Okay, a couple of examples. So we're using again Mr. X, who is 30 years old, has 10 years pensionable service with a salary of 300,000 Rand. As at the end of August, there's 0 in the savings pot, there's 0 in the retirement pot. His total benefit is 610,000 Rand. Okay. Mr. X then decides to resign 3 years after the implementation of the new 2-pot system, so that when he resigns, he's 43. His final salary has increased to 360,000, and we are now at the 31st of August 2027. Okay. If Mr. X had resigned on the 1st of August, then he would receive 610,791 rands according to the withdrawal tax tables. Okay. So we've got in this example, what we are saying is that Mr. X resigned at the end of 31 August, end of this month, and he then chooses to resign again comes back into the system and then resigns again on the 31st of August. So having resigned on the 31st of August 2024 means that his vested pot would have 0 rands because he would have withdrawn it on the 31st of August. But he has now served 3 years, 3 new years back in the system. So he's got 1 year accumulated in the savings pot of 74,000 Rand, and he has 2 years accumulated in the retirement pot, accounting to 148K, which leaves him with an amount of approximately 222,797 rands. Colleagues, this is to illustrate how the pension of a member who has chosen to resign end of August will look like versus a member 31st of August 2024 and then chooses to resign again on the in 3 years time. Now let's take the example let's assume Mr. X does not resign on the 31st of August 2024. He leaves his vested pot in the GEPF, but then he resigns 3 years later in 2027. Okay. So what this means now, he has not resigned in 2024, only resigning now in 2027. It means he has a vested pot of 10 years service, accounting to about 742,000 rands. He has a savings pot that's accumulated for 1/3 since 1 September, which is equivalent to 74,000. He has a retirement pot of approximately 148, amounting to a total benefit of 965,454. When Mr. X resigned, in this case, he will be entitled to a cash benefit of 742,657 rands, which is the vested pot plus the savings pot. The balance of 148,000 rands, 531, which is in the retirement pot, would be paid as a deferred pension only when the members retired. And then to reiterate my last point, he could choose to transfer his retirement pot to his new employer if he's resigning, or he can leave it within the GPF for him to receive the pension upon retirement. Okay, we've discussed the text at length now. Resignation with, you must understand, on withdrawal from savings pot marginal rates. Upon resignation withdrawal tax rates apply, and then upon retirement the retirement tax rates apply. So in this example, let's say a member has 15 years of vested service with accounts to R1,000,000. Because of their tax rate, upon resignation, roughly R199,700 will be deducted from the member as tax. The funds withdrawn from the savings pot are taxed based on the marginal tax rate. As mentioned, this is as per your salary. So let's get into an example. Let's say a member has 20,000 rands in their savings pot. The marginal tax rate is applied. In this case, the member is 30%, which means an amount of 6,000 rand will be deducted. So in the example, upon the withdrawal of the member, the value of the withdrawal is the 1 million rands that he has in his pot, in his vested pot, plus the 20,000 rand in the withdrawal. And if you take those two amounts of 199,000 rands and 6,000 rand, the total tax is then 205,000 rands, and that would apply and deducted from the member. In terms of retirement, the rules still apply in the GEPF in terms of the benefits that accrue to members. If a member has less than 10 years service, they are paid out a once-off gratuity and a lump sum. But if a member has 10 or more years service, they are entitled to receive a monthly pension. This monthly pension so the retirement pot can then be taken, as mentioned earlier, can be taken as a lump sum if the total retirement pot and annuity portion of the vested balance is lower than 165,000 rands. So just remember that if the value of the retirement pot is only 165,000, a member can get paid. But otherwise, what will happen is the amounts that are in the vested pot when a member goes on retirement will contribute towards the lump sum, as well as the pension benefit based on the vested service. The savings pot is meant to provide only a lump sum benefit, and the retirement pot is meant to provide a pension annuity. However, due to the structure of the GEPF, the two pots will be used to contribute to both your lump sum gratuity as well as your monthly annuity. Okay, let's go into an example in terms of retirement. A member has 25 years of vested service as at the end of August 2024. Let's ignore the seeding capital. And then they go on retirement 5 years later on the 1st of September 2029. And we're assuming again that they have an average salary of 300,000 Rand. Therefore, at retirement, the 3 service periods of the members would look like this. The member has 25 years vested service. He has 3 years and 4 months of retirement service and 1 year, 8 months in the saving service. And we assume he or she has not made any withdrawals. So then this is how the pension will be calculated. Simply look at the principal colleagues, the member's gratuity will be calculated on the years of vested service, and the years of saving service will be calculated to work out the gratuity. So we'll use the vested service and the amount in the savings pot. So those are the calculations, and what this means is that the member would receive roughly 604,800 rands as a gratuity. So let's not get stuck into the exact numbers, but the principle is that upon retirement, to work out your gratuity, it will be based on your vested pot as well as your savings pot. Annual portion, the annual pension, which is the member's acuity that is paid to a member guaranteed for 5 years. A portion of it will come from the vested pot, and then the entire amount in the retirement pot will be used towards the member's annual pension. In this example, it adds up to roughly 163,000 rands. To reiterate, colleagues, upon retirement, to work out the 1/3 gratuity, a portion of the vested pot will be taken, and the savings pot will contribute to the gratuity. A portion of the vested pot and the entire retirement pot will then be used to work out the member's monthly salary. Okay. So this is simply to show that there is no difference under the new two-pot system versus what the member would have received upon retirement. In the current regime, the member would still receive the same benefits. So this is an outcry to the members out there who are close to retirement that there is no need for you to resign. The benefits that will accrue to you post the introduction of the two-pot system versus what you would earn upon retirement now will be the same. You will not be disadvantaged in terms of retirement. The member would receive the same benefits, whether they retire under the current system or they retire within the new system post the 1st of September. So all those colleagues that are close to retirement, 2-3 years close to retirement, please do not panic and resign or submit your resignation forms. Stay within the system because your benefits will not change because of the new system. Okay. As mentioned, just to reiterate again, in terms of the tax on retirement, the retirement tax will apply. Where, for example, 550 of the gratuity is tax free, and the tax only is applied after. And then the pension will be taxed according to the tax rate of a pensioner, where pensioners get a lower tax rate. Okay. Okay. Only point to make here, the penalties with regards to early retirement still apply. As in the current system, if you take early retirement, again, on early retirement, any form of retirement, colleague, you get all your pots get paid out. You get paid your vested service, your savings service, and your retirement service upon retirement. Whether you take early retirement, ill health retirement, or normal retirement, or late retirement, all your pots will be paid out to you. The key thing is that the changes with regards to early retirement do not change. The penalties that apply to that will still apply. Okay. In terms of divorce, okay, the divorce can only pay an ex-spouse if we receive a court order instructing the GEPF to make a payment to a former spouse of a GEPF member. Okay, this will not change under the Newport system. We will still pay the member. So, for example, if the ex-spouse is entitled to 50% of the benefit, retirement benefit, this would entitle to the spouse to 50% of the vested pot, 50% of the retirement pot, 50% of the savings pot. So, in simple terms, colleague, one, situation stays the same. If an ex-spouse must be paid a divorce benefit, it will be paid to the member in cash. There is no issue that the ex-spouse will only receive a portion of the pension when the member retires. That's not correct. The member will be paid the full benefit that they are owed in cash. However, that benefit that will be paid to the member will be deducted from all the pots. It will be deducted from the vested pot, from the retirement pot, and the savings pot. And that makes sense, colleagues. It would be grossly unfair, for example, if we received a divorce order and we only took the funds out of the retirement pot to pay the member. That would significantly disadvantage the member at retirement. So the pension will be split. The divorce benefit that must be paid will be split proportionally across all the three pots and paid to the member's spouse. Health benefits do not change, colleagues. Please make sure that your nomination forms are up to date. Upon the passing of a member, the entire pots are paid out. Another myth that has been going around is that a member passes away, the beneficiaries of the member will not be able to receive the retirement pot until the member gets to the age when they were going to retire. This is incorrect, colleagues. Upon death, all three pots, vested pot, savings pot, retirement pot, all three pots will be paid out to the beneficiaries. No pot will remain in the GPF at any point. They will be paid out as per the applicable terms. Okay. A summary in terms of what's accessible with regards to the different pots. If a member leaves, exits the system due to resignation, retrenchment, or dismissal, the member can access their vested pot. That is why there's a tick. They can access their savings pot. It's a tick. They will not be able to access their retirement pot until the member retires. This also, a key thing to emphasize here, colleagues, this also applies to retrenchments and dismissals. If you are retrenched or dismissed, you cannot access your retirement pot. The savings withdrawals, no withdrawals are allowed from the vested pot. Members can make the withdrawals once a year from the savings pot. A point that I haven't mentioned as yet is that there must be a minimum of 2,000 Rand in the savings pot for members to make a withdrawal. But from 2,000 Rand to whatever the maximum amount is, they can withdraw. And then no withdrawals are allowed in the retirement pot. Upon a divorce, the benefit that must be paid to the ex-spouse will be deducted from the vested pot, the savings pot, and the retirement pot. If a member decides to leave the GEPF, perhaps they find another job in another area in the private sector, they can transfer all their pots. They can transfer the vested pot, the savings pot, or the retirement pot. It is not obligated, they are not obligated to leave the retirement pot within the GEPF. Then upon all retirements, the vested pot will be used to calculate a portion of the gratuity and the pension. The savings pot will be used towards the gratuity, and the retirement pot will be used towards the pension. Okay, let's not go into this. It's quite similar to what we explained. Okay, thanks, colleagues. We're close to the end of the presentation, and then we'll go to the questions. In terms of the claims process, work is being done. The claims process is being finalized. Importantly, colleagues, to make the simpler and easier, applications to make a withdrawal for a claim from the savings pot will be done through the GEPF app and the self-service platform. So it's very important, colleagues, if you are not registered on the app, please do so now in these 2 weeks leading up to the 1st of September. You can do it on the self-service, which is on the GPF website, or download the app, whether from App Store, whether it's from App Store, Play, or Huawei Gallery. For the different phones, you can download the GPF there, register, because this is the system that we will use for applications. For people that do not have access to laptops or smartphones and cannot do this, they will then need to go into a GPF office to get assistance in terms of submitting a claim. Okay, this is how it will work, colleagues. The system is currently being updated. I won't go into detail, but once you are logged in, there'll be an option to submit a claim. The claim will then, as per current process, you'll be able to see progress as the claim continues. Okay. Importantly, colleagues, the time frame for the payment of the withdrawal, due to obviously, colleagues, being a new system, a new structure, anticipation of the volume of claims that will come in, we are still working on the 60-day payment period for the payment of the withdrawals from the savings pot. This is important, colleagues, as we're obviously onboarding a new system. It's a new system for everybody. We are endeavoring to make sure that the process is obviously quicker and simpler for colleagues, but in terms of the allowed period, we will still work on the 60 days turnaround period, remembering that your text on marginal tax rates, the savings, the tax directive to SARS still needs to apply, and all of that. So we still require that 60-day time frame that to order to make the payments. Colleagues, we will have 2 more webinars this month. We will communicate the dates. One of the dates is next week and one in the week before the end of the month. Those 2 webinars, we will concentrate on the claims process. I'm not going into detail now because colleagues from the IT department who've developed the app and self-service will make a presentation on the claims process and take colleagues through the process in terms of exactly how they will be allowed to claim. So those 2 webinars, please join again to get an understanding of how the system will work. And we are targeting the beginning of September for claims process to open for members to be able to submit their claims from the savings pot. Yeah. I won't go into this, but simply to say, colleagues, it's a go. The GPF is endeavoring to be ready completely in time for members to make their withdrawals from the 1st of September. It's progressing well from what we understand. But obviously, colleagues, please bear with us. It's a new system. There are lots of colleagues that will submit claims. And if there are teething problems, we will work through them. But we're going full steam ahead to work towards implementing the system from the 1st of September. Then to close off, colleagues, with some advice. Colleagues, let's remember that this is an option for us to access fund during times of emergency. Colleagues, let us do that, because if we continue to withdraw at every point for reasons that are not necessary, it will impact us when we go on retirement, as we will have less funds for our retirement. Our pensions are for retirement. Let's keep that top of mind, that pensions are for retirement. Okay. And this option is simply to assist us in times of difficulty and emergency. If you do not need the funds in the savings pot, do not withdraw them, colleagues, simply because you can. We're imploring on members to keep in mind, pension is for retirement. Let's not lose sight of that fact in terms of our financial goals and what we want to achieve. And by all means, if we are faced with emergencies and difficult times, then we can make the withdrawals if necessary. Importantly, we will not, when you make an application to make a withdrawal, you will not be asked why you are making the withdrawal. Okay. It's up to colleagues to be cognizant of their own financial circumstances, to understand what their goals are for retirement, and to make their withdrawal cautiously and having considered it accordingly. So, colleagues, that's our advice for us, the GPF. Pensions are for retirement. Do not withdraw simply because you can. Really use it for cases of emergency, and this will ensure that that a member has a comfortable retirement. So, colleagues, I've said a lot. I hope that the majority of what I've said is clear and understandable. But let me take the time now to go into the questions one by one. Okay. Okay, there's a question from Alicia. Could a copy of the presentation be sent? Yes, the presentation can be sent. All those colleagues that would like a copy of the actual presentation, please drop your email addresses in the chat, and we will endeavor to share it with all of you. Furthermore, this webinar is being recorded, and we will post it. We will post it, and we will post it. Um, we will post it on. We will post it on YouTube, and we will share the link for colleagues to see. In terms of, there's a question from Tabi saying, Mapklape, is this information available on the GPF website? As I said, the recording itself and this presentation can be emailed to colleagues who drop in their email addresses in the chat, and then we will send it to them. On the website at GPF, there's a brochure that you can access. There's a poster. There's a Q&A section that is there for members that members can access. And as I said, on our YouTube channel, we also have the videos. We've loaded at least 4 videos. You might have seen we are in collaboration with Maya Fisher French, and she's already posted 3 videos giving further explanation about the two-pot system. Colleagues can also view those to get more information. So there's a lot of colleagues. Um, there's a lot of colleagues that are there's a lot of content that has been shared with members. There's a question from Conrad Coates. Nothing so far has been specifically been said about pre-98 tax freeze. We didn't put an example of this in the publication, but the member can obviously, like I said, in terms of tax, to get into deeper understanding of how you are implicated by tax, please, colleagues, contact SARS so that you get accurate information that is 100% correct and up to date. We are aware that the pre-98 people, there are examples, but you need to speak to SARS in that regard. Okay. Then there's a question from Sipo Shiko. Assume that I get employed on the 1st of September 24. Does that mean that the retirement pot is purely reserved for pension, and that if I have exhausted what I have is available in savings reserves, there won't be a cash lump sum paid? This is correct, Sipo. If over the years you continue to withdraw from your savings pot, you get to retirement and there is a zero balance in your savings pot, the gratuity, the retirement pot will then be used to pay you your monthly pension as indicated in the examples. Remember, the examples showed that to work out your gratuity for those members that have a vested pot, the gratuity will be paid out of the vested pot and the savings pot. The savings pot will only be used for the gratuity or the lump sum. The retirement pot will only be used for the monthly pension. So correct, if over the years, if you do not have a vested pot and you only have a savings, because you don't have a vested pot because you only started working on 1 September, and over the years, you withdraw all your funds from the savings pot. When you retire, you will not get a lump sum. You will receive the monthly annuity worked out from the retirement pot. Okay, I'm continuing to look at the questions. Is the question from Tabi Seng again? I get that we get taxed when we withdraw from the savings pot. Do we also get taxed when we retire? Tabi Seng, please remember that pension contributions while you are still in employment are not taxed. Let me make an example. If you earn 10,000 Rand a month, which is a gross amount, and you contribute 1,000 Rands of that towards your pension, the 1,000 Rands is not taxable. You will only get taxed on the 9,000 Rands. So you earn 10,000 Rands, 1,000 Rand you contribute towards pension. The tax that is calculated by SARS is on the 9,000 Rands, not the 1,000 Rands. This is why that when you reach retirement, then those pension contributions are then taxed. So please separate that. And yes, and also separate it from the withdrawal that you make from your savings pot. Again, you will have been contributing to your savings pot as a tax-free, so your contribution is going into your savings pot untaxed, and upon withdrawal, it is then taxed. Similarly, on retirement, your pension contribution are not taxed. Upon retirement, you then get taxed. It's a question from colleagues about how do I buy service. The service, this is Mahlwele. The service is bought. Applications can be submitted at your HR, at your human resources. They have the forms. The form is sent to the GEPF. You are then provided with a quote. Let's say you want to buy 2 years service. You are provided a quote in terms of how much that costs, and then you are required to confirm if you accept the quote, and thereafter then once you've made the payment, then the service is added to your service. Okay, looking for what if the GPF member dies after 5 years of being on retirement? Will the outstanding retirement pot still be paid to beneficiaries? This question is from Cindy Titus. Remember, colleagues, a GPF member's pension upon retirement is paid out as follows. 1/3 is paid as a lump sum gratuity in cash. 2/3 is paid as a monthly pension guaranteed for 5 years. What that means, colleague, let's take a simple example. Let's say a colleague has 1 million rands, has 3 million rands upon retirement. 1 million rand will be paid as a lump sum to the member and taxed accordingly. 2 million rands will be divided into 5 years or 60 months to work out a monthly pension. In this example, if you divide 2 million rands over 60 months, that works out to roughly 33,000 rands a month that the member would receive. And that pension is guaranteed for 5 years. At the end of 5 years, colleagues, a member has been paid their 1/3, 1 million rand as a lump sum, and they have been paid their entire pension that they've earned as a monthly annuity for 5 years. So at the end of 5 years, a member has been paid their entire pension interest that they've accumulated. I hope it's clear, colleagues. At the end of 5 years, if you've retired, you've been paid all your money that you have earned while you were still in employment. However, the GEPF continues to pay a monthly pension until you pass on. However, that monthly pension you are now receiving after 5 years is a benefit accrued to you because you are a member of the GEPF. Your pension has already been paid to you that you have accumulated. Okay. So at the end of 5 years, all that is left for beneficiaries to claim is the usual benefits, a funeral benefit. The spouse can claim the spouse pension. Children younger than 21 years and younger can claim the child pension. That is what is available. There is nothing left in the retirement pot because it would have been paid in its entirety to the member. I hope that is clear for Cindy and understandable. Okay, let's look for another question. I'm just going to keep going, colleagues, until 12 o'clock on the questions. There's a comment from anonymous user that the GPF has not been functional with existing passwords. We are aware of this, colleagues, that there are some colleagues that have been struggling. What colleagues need to do, if you are struggling when you try to log on, try the register option. Click register, go into the app and click on register. If you are still struggling with register, go to the website version on the website, the self-service on the website. Okay? On the website. On there, once you are in, there's an auto questionnaire which can verify your details. And then if that doesn't work, then please send an email to the email address that is provided. And there's also a number and you can contact the call center, or you can contact us on the social media platforms to try and assist you. I'm looking for another question, colleagues. I'm reading them from the bottom up. So I'm just scrolling down. I'm just scrolling down to the bottom of the messages to see if I haven't missed any questions. Okay, there's a question from Jafta. Can I resign and leave all 3 pots with GPF and be eligible for lump sum? Medical aid service over 15 years and pension when I turn 55 years old. The answer to that, Jafta, is yes. You can leave your pot upon retirement, upon resignation in the GPF if you so choose. However, please be cognizant that the GPF is not a preservation fund. And therefore, you would need to consider that after having had a clear discussion with your financial advisor in terms of how much your money would accumulate and earn and all of that. So the answer, a simple answer is yes, but please speak to your financial advisor in terms of your options available to you, because you are also able to transfer the pot to your new employment. And yes, if you left them until retirement, we would then pay you according to what we've shared, that you get a gratuity and a monthly pension if your service was over the 10 years at the time you were within the GPF. There's a question from Trevor. What would be the difference in payout? What would the difference be? The difference in payout be if I resigned before 1st September compared to resigning a year later? Trevor, the biggest change is that of the pension that you accumulate after 1 September. Remember, after 1 September, your pension accumulates now in the savings pot, 1/3, and 2/3 accumulate in the retirement pot. So if you resign after 1 September, let's say you resign a year later, you resign on 1 September 2025. What it means is on resignation, you will receive your vested pot, which is your pension that you accumulated up until 31 August 2024. You will receive what you have accumulated in your savings pot. The new savings pot that you would have accumulated from 1 September 2024 to 31 August 2025, you can take that as a cash amount as well. The two pots that the two-thirds that you've accumulated in the new retirement pot from 1 September 2024 to 1 September 2025, you cannot withdraw. That you have to either leave within the GPF, or you can transfer it to another fund of your choice, but it will not be paid out to you in cash until you reach the age of retirement. Yeah. Just looking for more questions, colleagues. Colleagues, I see all your the colleagues that have submitted their email addresses. We'll definitely share the presentation to all the colleagues that have said them. I see them. I haven't published them for everybody to see, but we see the email addresses on our side. So yeah, don't be concerned if you don't see it in the chat. We do see your email addresses, and we will share the presentation. Floretta says that she retires at the end of December. That is completely fine, Floretta. As I said in the one example I provided, if you retire, Floretta is retiring. If you retire post 1 September, it will have no impact on your benefits. You will still receive your benefits as you would as you as you would have received them before. So please don't panic. Do not retire before 1 September. You will not It will not impact your benefits. Mm. Just looking for more colleagues, for more questions, colleagues. Um, the question from Mako Sazana, which says, "What if I owe SARS?" As explained, colleagues, if you make a withdrawal from your savings pot, you will be taxed at your marginal rate. Furthermore, if you owe SARS any tax from previous years, you are behind, SARS will deduct the pension the tax that you owe them from the withdrawal. So what you will get is what you withdraw minus tax at your marginal rate minus what you owe SARS, and that is what you will receive in your bank account. And there's a question from Hufwane or Silibucho. Does this now mean there will be an open period every year going forward to claim from your savings pot, or you can claim whenever? Correct, Hufwane. It's not that there's a specific period that you say for example, GPF says we open February, we open June for applications. You can you can claim anytime in the year within the tax year. The tax year is 1 March of each year to 28 Feb of each year. So you can choose at any point if you want to make a withdrawal. GPF is not going to say we've got a window, now we're receiving applications, now we are closed. No. Anytime during the year, you can apply to make a withdrawal. As mentioned, colleagues, the application process is through the app or the self-service. So please download them. If you have issues, then you need to go into a GPA office to get assistance. And there is a question from Henrico Adams. If I get a job at City of Cape Town or National Design Department, can I resign from Western Cape government and take my money and start over at this new department? The answer there, Enrico, is that technically yes. If your service if your service period from your previous employer is not linked to your new service in your new department, meaning that you have two pension numbers. Let's say you are working at Department of Health and you have a pension number and you worked there for 5 years. You leave, you get a new job at the Department of Defense, and you move to the Department of Defense to start new work, and you get a new pension number. Technically, yes, you can claim the service that you accumulated on the old pension number from the Department of Health. However, if everything is done seamlessly and your pensions are linked, so your health from your old employer being Department of Health is linked with your new employer being Department of Defense, and it's all captured out against one pension number, then you will not be able to withdraw. Okay, which is the way that it's supposed to happen. When colleagues move jobs, they're supposed to be carrying their pension across to the new employer and linked under one pension number. But we understand that often doesn't happen, and members get a new pension number, which means they have two pension records. So yes, in that case, you can claim the pension. And there's a question from Ndumiso Ngobo. How is the monthly amount after 5 years during retirement calculated? It will continue. If you are earning 20,000 Rand monthly pension, and then your 5 years, the 5 years of guaranteed monthly pension comes to an end at the end of 5 years, you will continue to earn 20,000 Rand plus increases on an annual basis. Your pension is not reduced after the 5 years. If a member is still alive, they continue to receive, if they were earning 20,000, they'll continue to earn 20,000 plus increases. So it's got no impact on the value of their pension. The only thing is that after the 5 years, when the member passes on, there is no longer an amount that the pensioners beneficiaries can claim, because the member's pension has been paid out completely to them. I'm looking for more questions, colleagues. I just need to scroll down because every time there's new questions, the chat goes up. So I just need to scroll down. There's a question from Shelley, which says, does the retirement pot accumulate from 1 September 2024? And if I resign, does the amount on the retirement stay the same, or it will accumulate interest until I reach retirement age? The answer to that, the first part of the question, Shirley, is that yes, the retirement pot will begin to accumulate from your first contribution at the end of September. It will accumulate. 2/3 of your pension will accumulate there. And then if you resign and you leave your retirement pot in the GEPF, yes, it will earn some interest, but there's a that there are rules around that in terms of the GPF, in terms of how much interest it will earn. So yes, it will accumulate. And remember, if you are still within the system, of course, it will accumulate with each monthly contribution. Another question, colleagues. Yeah, a very important question, colleagues, from anonymous user. Do you reduce 4 months for every withdrawal, or it depends on the amount you withdraw? Colleagues, I made the point that the amount that we will reduce your pensionable service by will be calculated, and it depends on each member because we contribute different amounts to pension. If A pensioner, if a member contributes 10,000 rands to pension and another member contributes 5,000 rand, and they both make a withdrawal of 30,000 rands, the impact of the 30,000 rand withdrawal is higher on the person who contributes 5,000 rands pension versus the pension person who contributes 10,000 rands. So it will be calculated based on your individual circumstances. You can't say because Sonke withdraw 30,000 rand and his service was only reduced by 1 year. I withdraw 30,000 rands and mine was reduced by 2. It is not the same. It will be calculated. It can't be the same because we contribute different amounts. We hope that is clear, colleagues. There's a question from Zara. Does GEPF use the future notch or the notch of 31 August 2024 when an employee resigns and has a vested pot, for example, resignation with effect from 31 August? Yes, very important question, Zara. So remember what we're saying, your vested pot, what is logged about your vested pot as at 31 August 2024 is only the years of service. So if your years of service at the end of 31 August 2024 are 10 years, we will always calculate your vested service based on 10 years. However, to your point, your salary notch will increase. So in 1 September 2025, you might have received a salary increase. So we will use your new salary to calculate your vested pot, and we will use your new actuarial factors based on your age. So to answer your question, you are 100% correct. Years of service locked, but you've got a new salary notch in 2025. We will use your new salary notch. We will use your new actuarial factor to calculate your vested pot. Colleagues, I'm looking for questions. I'm still here. I'm still here for colleagues that are still online. I'm just scrolling to find questions to respond. It's just a bit tedious because I have to scroll down the page to find the question. There's a question from Jess. A quick question. Can I withdraw the same time as with my bonus date, and will I be taxed on both? Your bonus it does not relate to the GPF. It is completely separate. And yes, it relates to your employer. And absolutely, yes, you will be taxed. To answer your question, you can withdraw anytime in a tax year. It has no impact on your bonus for us. The process of the bonus is an employer process. The process of withdrawing from the savings pot is a GPF process. The two are not linked. It doesn't matter if you do it at the same time or different times. The two are completely separate and are not linked. And yes, you can apply at the same time if you so choose. So that is not a factor because the GPF has nothing to do with the payment of your bonus. There's a comment from Regina that we used to be able to update beneficiaries on the system, but recently it does not allow. After you change later, when you check, it's still the same as previously. So yes, colleagues, when you update your details on the app and self-service, it does not pull through automatically. The information is received and then it's got to be updated on the system. So that is the delay. So what I would advise to colleagues, please continue to update, make comments, follow up with the call center, but the update will be done. It's just that it's not automatically linked to happen immediately because the information must be verified and then the details will come up. Looking for another question, colleagues. We've still got 5 more minutes until 12 o'clock. There's a colleague who's asking about the claim process. As mentioned, in the way to claim is through the app on self-service or the GPF app. If you cannot use those systems, you must go into a GPF office to complete your application forms and withdrawals for the withdrawal. And as mentioned, the next 2 webinars that we will host, we will dive deeply into the claim process and how it works. It's just that we're saving that, and we will do that in the next webinars. But key point, we will use self-service and the app for submitting claims. Looking for another question. I'm just scrolling, colleagues, to look for another question. There's a question from M. Mahlase. If I withdraw my savings, it will affect my value benefits with the amount I have withdrawn from my savings, or what? As explained, Mahlase, in terms of the GEPF, it's not the amount. Your savings will not just be reduced by the amount you withdraw, say 30,000 rands. We have to account for that 30,000 rands in terms of your years of service. What we will reduce is your years of service. So we will calculate based on your circumstances what the withdrawal of 30,000 equates to in terms of years of service. So for your case, because you contribute a certain amount, etc., we might work out that 30,000 rands for you equates to 6 months service. And then we will reduce your service by 6 months. So it's not the actual amount, the 30,000, that matters. It's what that 30,000 equates to in terms of pensionable service. I hope that clarifies for you. Just scrolling, colleagues, to find more questions. Scrolling. I'm seeing a lot of email addresses, colleagues. Rest assured, we can see your emails and we will send you the presentation. We'll see. I will send to all of you. We will blind copy you, so you will not be able to see the other colleagues' email. So yeah, we will definitely send it during the course of today still. And there's a question from Isaac Mkasibe. I know if I owe SARS, they can get whatever I'm from my pension. Can the financial institution that I owe have access to my pension payout before it reaches my hands? From my understanding on that one, if what you mean is that you owe another institution funds, let's say you borrowed money from RCS or another institution, you are asking if that institution can simply claim from your withdrawal. Our understanding is that in that regard, it's not the case. It's only SARS that can make a withdrawal before you receive the money. In that case, that institution, if you owe them and you haven't paid them, they would have to go through the formal process. They would have to contact your supplier, do a garnishee order, or whatever that process is that they follow to get you to pay. So they definitely cannot do it automatically. They can do it obviously through a legal process, through an employer, that your employer must deduct what you owe them, etc. But with the withdrawals, it most certainly will not happen automatically, that you submit your withdrawal and then another company where you have a loan and you owe them and then they come in and also deduct. That will definitely not happen automatically unless they have applied through formal process and legal process for your employer to deduct the money and pay them. So it will not happen during this process. Only SARS will be able to deduct what you owe them from your withdrawal. Just scrolling for other questions, colleagues. There's a question from Nico. If I retire at 55, will I be paid my retirement pot till one say goodbye to earth? What I will say, Nico, is that upon retirement, form of retirement, early retirement, ill health retirement, normal retirement, late retirement, you will be paid all your pots, your vested pot, your savings pot, your retirement pot, and you will get your monthly pension, 5 years guaranteed as mentioned, and then after 5 years, you will continue to receive it until you pass on. Absolutely. Do note that retiring after 60 from 55 upwards is early retirement, and penalties do apply, and those will reduce the benefits that you receive. I'm gonna give it just an extra 5 minute, colleagues. We are at 12 o'clock. I'm just gonna allow just an extra 5 minutes for one or two more questions. It's a very important question here from Dumiso. Is it possible to first submit a quotation to see how much service will be reduced before submitting a final request for savings withdrawal? This is a very important question, Dumiso, and I'm going to admit that I am not sure if colleagues will be allowed to get a quote to see what the impact of the withdrawal will be. So I'm going to park the response to that one for now. I think we will definitely, when we do the claims process, we will make sure that we have an answer for that, whether colleagues can request a quote first, so that if a colleague sees that if I make this withdrawal, I'm going to be reduced 2 years and maybe it's not worth it, I don't want to withdraw anymore. Right now, colleagues, I must admit that I'm not sure. That question has caught me slightly off guard. I hadn't considered it. I am not sure if there will be a process for colleagues to get a quote before they formally make a withdrawal. So next week, when we do the webinar and we go through the claims process, we will definitely speak to that question and answer whether colleagues will be allowed to request a quote or they might simply apply and see after the fact. Thanks, Dumiso. Very, very important question. Very important. Just looking to see if there's more questions. I think, colleagues, what I'll do, I'll take one more question and then I'll close, because what I'm seeing now is everybody's email address, which is all fine. Colleagues, don't worry if you don't see it in the chat. We see it, and we will email the presentation to everyone as requested. As a simple question, what happens if I get divorced? Colleagues, as mentioned, your spouse will be paid out what they are owed as a cash lump sum. And what we will do, we will take the money proportionally from all your pots. We will take a portion from your vested pot, a portion from your savings pot, and a portion from your retirement pot. And the colleague will be paid out everything in cash. There's nothing that the colleague will have to wait until you retire before they are paid from your retirement pot. That money as well will be paid to them in cash. Anonymous user is asking, what is a gratuity? The gratuity is simply the lump sum payment that you get paid upon retirement, resignation, or any other form of exit. A question from Rina Klopper. Do you have to work through HR if you purchase? Yes. Yes, Rina, you have to submit and complete the forms at the HR, at your HR. They then send that application through to us. We review it. We provide you a quote of how much it costs to purchase the service. And thereafter, if you make the payment, then we add the years of service. Very important question from Conrad Quartz. Will GEPF implement a transaction fee for savings withdrawal? The answer is no. Remember, we are a defined benefit fund, so a lot of the administration costs we manage from our side, from the fund as the GPF. We do not charge members individually for a lot of the admin. There's admin fees that are accounted for from our side, but their members are not charged. So when you make a withdrawal, you will not see maybe like a 200 admin fee or anything like that that will be charged to you. We will not charge that. Any costs will be managed from the side of the GPF, not charged on members. It's a very important question from Francie. Why does the GPF not pay a person when they have been retrenched? Because when a person has been retrenched, they have no money. Francie, this is the law as it stands. GEPF did not write the law. The policy maker of the law is National Treasury or the Ministry of Finance. They have made the determination that even upon retrenchment, a person cannot access their retirement pot, which applies to resignation as well, or when a person is dismissed. It is the law. It was not decided upon by the GPF. It's not the GPF's law. It's the law of the country as determined by the Ministry of Finance, and it applies to all pension funds, whether in the public sector or the private sector. Colleagues, I'm now going to stop there and thank you very much for your time and for your attention. I do hope that the session has been fruitful and it has helped perhaps clarify some of the questions that you have. But again, it does not stop here. You can continue contact us through the call center, the various email addresses on social media, and we will share the recording. We will place it on YouTube and post about it on social media. And we will send the presentation to all the colleagues that have supplied the email addresses. Don't worry that you don't see your email address in the chat. We do have them. We're keeping it public for your safety, that not everyone can see your email address. And when we send it out, everybody will be blind copied so that other people do not see your email address. Thank you very much, colleagues. Thank you for your time. Thank you for your attention. And we will see you again in the next webinar in the coming 2 weeks. Thank you very much, colleagues. Bye and have a great weekend.